Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I'm Austin Wilson, co-portfolio manager at Hixon Zuercher Capital Management.
And I'm Josh Robb, director of wealth management at Hixon Zuercher Capital Management. How can people help us grow our podcast?
Please subscribe if you're not subscribed already so you get new episodes when they drop on Thursdays. Also, if you could leave us a review on Apple Podcasts or Spotify or wherever you're listening, that'd be greatly appreciated and help us to be found by more people. So today, with that housekeeping behind us,
Yes.
we're talking about the recent Fed rate cut, the first one in a while, and what that means for markets and you as a consumer and an investor.
That's right. Because, nothing drives the economy like a good old Fed rate cut.
It's so interesting that we have become very fine-tuned to what the Fed is doing.
Oh, they
and
watch and listen and dissect.
every
Oh,
word.
man.
And
Did he blink twice before he said that?
this was not always the way.
No. I can
fact,
remember back in the day,
there
they
was
didn't
no
even
press conferences.
Yeah, I was going to say, they didn't even tell you. They just did
Yeah.
whatever they wanted.
So we're in a new environment where the Fed is very keen on communicating well
That's good.
what they've done, what they're going to do, what their plans are, what they're seeing. But the markets are very closely watching this.
Yes.
So that's why it's very important. It's something we're going to talk about. So what happened?
Yep.
Well, on the 18th of September,
Mhm.
the Federal Reserve cut interest rates by 0.5%, 50 basis points, which is technically a two cut.
Yeah, because
Like,
they go in
usually-
25.
Usually you increase or decrease a normal one in 25 basis points or 0.25%
Yep.
increments. This was a double.
Okay.
And they also, what they did when they released their summary of economic projections, their SEP, is they signaled more rate cuts to come this year and quite a few more rate cuts to come next year. They would like to phrase this all as normalizing interest rates.
Right. They're not cutting, they're bringing it back to normal.
They are cutting.
I mean, it's a cut,
They're
but-
cutting, but
yeah.
they're not doing it because things are falling off
Yes.
a cliff, right?
Yes.
They're not doing it because the economy's shutting down
As
or
opposed
whatever.
to 0809, where they cut rates to help stimulate because the economy was struggling.
So there's a difference between a proactive rate cut and a reactive rate cut. A reactive rate cut would be things are really bad and we need to reactively cut rates to stimulate growth. A proactive rate cut would be things are slowing a little bit and we've kind of gotten where we think we should be on things like inflation is kind of the key one right now. So we're going to proactively cut rates to make sure that we can extend this expansion as long as possible.
Okay.
So we are in the latter phase right now where it doesn't seem like there's a recession on the imminent horizon.
Right.
Obviously, there's always going to be another recession.
Yeah.
But there isn't one right now in front of us.
Because
So they're cutting
recessions
rates.
are part of a normal economic cycle.
Absolutely.
When things get too far out of whack, a
Yes.
recession helps bring them back to more normal. Okay.
Yeah, so we're not quite there. So this is the Fed saying rates are too restrictive. We just want to make them more normal,
Okay.
right? To stop slowing the economy as much with our high rates. So yeah, 50 basis points, more rate cuts coming there. In fact, I would anticipate in the next two meetings, there's two more meetings the rest of this year. Markets are pricing in and it makes sense. You'll probably get another 75-ish basis points. So that'd be a total of three cuts, either a 2 and a 1 or a 1 and a 2 throughout the rest of the year.
Okay.
And then quite a few more next year to get rates down to about 3.5% by the end of 2025. And that's more of a normal Fed funds rate,
All
right? So that's kind of where we're at right now. There was one Fed governor who said, whoa, this is too much. We shouldn't do that. That was Governor Bowman. He said 25 basis points. However, the majority of the Fed governors were like, yeah, give us 50. It makes a lot of sense. The Fed also, in their summary of economic projections, revised their unemployment forecast up to 4.4% for next year. So they have a lot of confidence in the economy growing overall, and that's really kind of not much of an increase from where we are right now in terms of unemployment. So they think we'll be able to have positive economic growth without damaging the labor market too much. A little bit more slowing, but not a ton. And then inflation in the U.S. obviously has eased, but they're also playing this game where the Fed, which is our central bank, is discussing things and looking at things and from other central banks around the world, like the Bank of England, the European Union.
Yep.
And they're kind of working together here, right? So we're going to lower rates. The Bank of England's going to lower rates. European Union's going to cut rates. We'll have to just kind of work together on this because inflation was a global problem.
Right.
It's kind of a global solution to work together to bring monetary policy back
And
to normal.
we seem to be a little bit ahead of everybody else when it comes to the recovery. Our inflation came down a little bit quicker and is lower than Europe and overseas. So it makes sense that we're the first ones to kind of start this process.
We're certainly, and we're the largest. That's the thing too. So our monetary policy changes have a much bigger impact on the globe than most other areas of the world. So that's what happened. The Fed cut rates, right? First time in a while. What have markets done is the next question. So let's talk about markets. The S&P 500 generally. So this is 505. Why is it 505 and not 500? Ask Standard & Poor's. 505 of the largest U.S. companies. That index generally has risen after the first rate cut of an easing cycle, but its performance has been weaker than usual over time. If you look 1 week, 1 month, 3 months, 6 months, and 1 year out, mixed results, but generally higher. Just kind of mixed, whether it's more or less than average, right? Historically, the S&P 500 returns 4.9% on average 1 year after that first interest rate cut, seeing positive returns nearly 70% of the time. So that's actually not an amazing 1 year number. It's a little bit below what you'd expect, but it's positive. In 3 months following a rate cut, the market has typically dipped, but rebounds before the 6 month mark. That's historically what has happened. And this is really aligning with a conventional wisdom that lower interest rates stimulate economic activity because borrowing rates and borrowing costs are lower for businesses and consumers, and this does tend to benefit the stock market overall. S&P 500 performance following rate cut cycles can vary significantly, however. A couple examples here. U.S. equities saw double-digit declines after the first rate cut in 73, 81, 01, and 07. So that'd be obviously the last two there, tech bubble and housing crisis. On the other hand, the flip side of that is the S&P 500 was up 36.5% after the 82 rate cut cycle.
I'll take that one.
And in the most recent rate cut cycle, the S&P 500 was up 14.5% in the following year. So mixed results, which way it could go. That's why averages are hard to look at.
Well, and probably some of those depend on whether they were, like you said, reactive or proactive, because if they're reacting to something, that may be part of why the market is down. Like I look at the 07 or the 01, there was a lot going on there that we were in a recession. There was reasons why the Fed was cutting, not being proactive, but they were reacting to an economic situation.
And I've had a lot of people ask me, just what does this mean? And I really say it depends. That's a great answer, right? But it depends on what happens, right? So if you get the soft landing thinking, so this is meaning the Fed lands the plane, no imminent recession, they've done their job, things get back to normal, the expansion continues. I don't really see that as causing much negative market.
Right.
But if you get the hard landing, right, you get a recession out of this, that does put pressure on companies. And I think that is ultimately what could cause a bear market.
Because we've talked about this. A recession and bear market are not the same thing.
Not always the same.
And they don't always happen in the same time frame. So, yes. So Fed is reacting to economic things, not the stock market.
Correct.
We're just looking at how the stock market reacts to what the Fed is doing.
So if you want to know my opinion right now, which of those two options are we looking at? This is just an opinion.
This is Austin Wilson's opinion.
Take this for what it's worth. As of right now, it seems like we're heading for a soft landing.
Yep.
I believe that the economic indicators the labor market's still pretty strong. It's not as strong as it was, but it's pretty strong. Inflation's come down. Consumers are still spending money. That's 2/3 of our economy. I think we're off to a more likely soft landing than hard landing, which should be supportive. I'm not saying crazy returns expected, but supportive for positive stock market returns.
Okay.
An opinion, right? Everyone's got one. So really what this comes down to is earnings. So positive earnings growth are what's going to cause the S&P 500 and the market overall to go higher over this next year. And when positive earnings occur, the market's averages 14% returns 1 year after that. When earnings decline during periods of falling interest rates, the S&P 500 is only averaged by 7. So again, you get those positive earnings, you get that economy to be growing, people to be spending money, you're going to have a better year likely than a worse year. A couple other areas of the market that are noteworthy of what happens in this, crude oil. very volatile in the interest rate cutting cycles, often declining in the short term, but swinging widely 1 year later, could go one way or the other.
Yeah. In crude oil, to me, there's so many outlying factors. I mean, you have the Middle East. There's a lot of pricing that happens by things that are going on over there. And so that one is always a weird one to me. I feel like it's harder indicator of anything because there's so many other factors impacting it.
Gold is something that's very closely, watched when it relates to interest rates. It's done pretty well after rate cuts typically. It dropped in 1998, pretty significantly after that. But in 07 and 19, the cutting cycles, actually gold was up pretty sharply after that. So just an area of the market we're not necessarily always the most big proponents of. We've talked about this before, but it does work in tandem with interest rates in a lot of ways when opposite, right? Industrial metals, copper, typically decline in the short term there. That's all usually related to concerns about economic activity. So again, you get favorable economic activity that could do okay either way. And bonds, generally positive returns after the first rate cut. Only one instance, which would be 1998, where you had fluctuations between modest gains and losses, kind of flattish there. But generally speaking, it makes sense. Bond math would say interest rates go down,
prices go up.
Bond prices go up. So again, maybe it's not going to be gangbusters for bonds, but back to the world of positive returns for bonds.
Good. All right, let's take a break. We'll come back and look at how the consumer and investor are impacted by this. But first, I got a dad joke.
Bring it.
Austin, did you hear that the Energizer Bunny was arrested?
I did not hear.
Charged with battery.
Charged with battery. That's good.
Yes.
Fun fact.
Yes.
Costco.
Buy
Kirkland batteries at Costco.
Yeah.
They're Duracell.
Are they really? Interesting.
Yeah. So that's where we buy all our batteries.
Yeah. You get a big pack of them too.
You get a big pack. You can buy Duracell right next to them.
And there are more?
Yeah. Buy Kirkland. Kirkland King, baby.
There it
That's
is.
what George Camel would say, the Ramsey guy. He's a Costco.
He likes Costco.
Yeah. All right. So we've talked about what happened from the Fed. We talked about what markets have typically done after this. But let's talk about what this means for you, both as consumers and investors. So I have 5 thoughts of each of these.
Yes.
For consumers, so this is you as a consumer, borrowing costs are going to be lower if you need to borrow money. So interest rates on loans like mortgages, auto loans, credit cards, these obviously tend to decrease when interest rates come down. Cheaper for consumers to borrow and finance big purchases because all interest rates are in some way, shape, or form affected by the Fed lowering the very short overnight lending rate to banks.
Because that's all this is.
Yes.
It's the overnight lending to bank.
Yes.
But then the bank says, okay, if I'm getting charged less, I can adjust my rates going upward. So that's how it impacts everybody. The Fed actually doesn't control anything else.
They only control the front end of the curve.
Yep.
Well,
so that's all they have.
Unless we get into the questions about their balance sheet, which that's another
from these rate
topic.
cuts, the only thing they're impacting is one thing, which is the overnight lending.
Yep. So number 2, refinancing opportunities. So suppose you bought a home in the last year or and a half or whatever, where maybe you have a 7% mortgage. That's pretty high. Well, if you within another year or 2 maybe get rates down into the 5s, there is a point,
2% savings.
There's a point where there's math out there, you can look it up, but there's a point where it makes sense to think about refinancing because you'll save more over the life of the loan,
even with closing costs. Yep.
Yeah. So refinancing opportunities may be available. Another thing is higher access to credit. So banks may be more willing to lend, which is going to give you more access to personal loans, home equity loans, other financial products because rates are coming down. This could stimulate consumer spending, which we're hoping it doesn't to the point of inflation going up, but it could stimulate consumer spending because consumers are going to feel more confident spending, which is going to make demand for goods and services higher, which can drive economic growth, as we know. 67% of our economy is driven by the consumer spending, so hopefully that does continue there. Another thing that's negative, though, so we've had this period where it's been unusual in recent history, but you could put money in a high-yield savings account or buy a CD and get 5%.
Yes.
That's really good.
That's a lot. Yep.
Considering what we had got
over the last 15 years. Yeah.
You were getting nothing. That's going to get much more normal, right? Yes. So you're not going to get 5. You might get 3.5 in a year or so. Still better than nothing, but a lot different than 5.
Yep.
So my personal opinion on this is cash is in an investment period. So don't be counting on your cash earning a bunch for you. Although it's nice when you do get something, but this is where cash coming off the sidelines and going into bonds or stocks is where hopefully people decide to put their money.
Right.
So consumers. We
consumers.
talked about consumers.
Yep.
But as investors, what does this mean? like we talked about earlier, number one, this probably could mean some gains in the stock market if we don't have a recession.
Right.
Again, that's, I think, the key here.
Mm-hmm.
If you get a recession, all bets are off. The market will probably go down, right? Stocks can be more attractive compared to bonds when rates go down, which means that you could have potential gains in sectors like technology, growth-oriented things, because of when interest rates go down, those future earnings and cash flows of growth companies are typically more attractive. So stock market could do okay. Number two, bonds, like we talked about earlier, could do okay as well. As rates fall, bond prices rise, lead to higher returns on existing bonds. So this could be capital appreciation, even as those yields, the income is going to come down, the yield's going to go, or the price is going to go up, right?
Right.
Dividend stocks, mixed opinions on whether this is good or bad for dividend stocks. High dividend stocks may actually have some appeal because they're often compared to bonds as bond proxies.
From a yield standpoint.
So they could be more attractive compared to bonds, but also they could be less relatively attractive compared to growth stocks, which pay less yield as well, which are going to be more premiumly favored. So
right. And growth stocks, less borrowing actually helps them.
Correct.
So they may look more favorable. Gotcha. Yep.
Commodities, we talked about that a little bit too. Could be mixed. Oil and metals may have some volatility. The dollar could be weakened through this because of interest rate differentials, and that really could increase global demand for commodities, but it also could, depending on the economic situation, obviously decrease them as well. So watching out for that. That could have implications there. And finally, real estate, especially real estate investments like publicly traded real estate investment trusts.
Yep.
Lower interest rates drive demand for real estate, which is going to benefit these investment companies which buy and manage real estate.
Because one of the factors of real estate is the income you receive. So like a REIT, a real estate investment trust, the whole appeal to those is they usually have a high dividend yield because they'll collect the rent from their properties and distribute that out to the shareholders. Up to what, 90%?
They have to distribute their income
for
tax purposes. So that's one aspect of it. But also these companies borrow lots of money to operate.
Yep.
And their operating costs are going to be lower then as well. So it could be relatively attractive for real estate. So here's, the nuts and bolts of this come down to, you got the first of probably quite a few cuts coming. This is a great time to be moving cash off the sidelines into investments, provided we don't have an economic recession. Again, this whole thing hinges on if we have a recession, nothing is safe. It's going to be pretty rough out there. But as of right now, it doesn't look like we're going to be having a recession. So it should be a favorable market for fixed income or equities over the next year or so, at least. So yeah, I'm excited about this cutting cycle, not fearful. In other cutting cycles we've had recently have been very reactive. This proactive one seems opportunistic.
And I would say the last time we did this was 2019, and it actually was going very well. COVID is really what disrupted this.
Absolutely.
Right? So if we look back at that one, you kind of had some stats on it, but the economy actually reacted very positive to this, and it was doing well, but COVID really disrupted their plan as well as how the economy was moving along. So, again, historically speaking, like you said, as long as the economy maintains a healthy kind of growth, that 1%, 2%, 3% growth, which is what we expect from our size of economy, things tend to do all right with these type of cycles. So yeah, again, I think I'm on the same page as you from a consumer standpoint. Unless you're looking for new debt, you may not even realize or notice much change at all.
Right.
You may see your savings account rates change a little bit, but other than that, unless you're looking for debt, it shouldn't really have a big impact on your life. And that's kind of the Fed's whole goal is like, let's just do this in a way that really doesn't disrupt anything. And that's really what they're trying to do.
Well, that's the Fed. So they cut rates. Maybe you had someone asking what that really means. We'll send this episode to them and maybe they can get a little bit of help, and email us any ideas for any other episodes you have to hello@theinvesteddads.com. Until next episode, have a good one.
Talk to you later.
Thanks. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.